Rental rates across the Fraser Valley are falling, and I don't mean they are softening a little. Surrey City Centre is just recorded one of the sharpest rental declines in the entire province over the last year. We are talking a 12% drop in asking rents. And in Newton, some landlords are down nearly 20% from the peak. Let that sink in. If you own a rental property in Langley or Surrey right now, this video is going to explain exactly why that's happening and what it means for you. Whether you're a landlord trying to understand your cash flows, or an investor who bought a pre-sale condo in Willoughby or in Whalley, or a buyer trying to figure out, is this the right time? You need to understand what's going on underneath the surface of this rental market right now. I'm going to walk you through the four forces driving this correction: supply, demographic, investor math, and the SkyTrain. That's a wild card. Real data, no hype. Let's get into it. To understand what's happening to rents in the Fraser Valley right now, you have to start with supply. Because for the past few years, developers responded to historically tight rental conditions by building, and building a lot. Here's something most people don't know about how construction data works in Canada. A project isn't counted as a housing start when shovel goes to ground. It's only counted when the foundation reaches grade, which in a large multifamily building can be 12 to 18 months after construction began. The units completing today, those decisions were made between 2021 and 2023, when the rates were lower, when rental demand was through the roof, and when investors fully expected rents to keep climbing. Across BC, we saw approximately 26,000 purpose-built rental completions in 2025, a record number. And the CMHC specifically flagged that Surrey's new rental units were facing leasing difficulties. In Surrey City Centre alone, the Whalley corridor near King George and Surrey Central Station, there are currently 308 active listings. Brand new purpose-built towers completing against investor-owned condos. Everyone is racing to find a tenant. That's a recipe for downward pressure on rentals. And it's not just Surrey. In Willoughby Langley, hundreds of new condos and townhouses completed simultaneously. That one and two bedroom market that investors love is now flooded with competing listings. On the other hand, supply alone doesn't tell the story. The other half of this equation is demand. And on the demand side, something significant has happened. Between 2021 and 2024, Canada experienced a historic surge in non-permanent residents, international students, temporary foreign workers, visa holders. Almost all of them were renters. This group drove rental demand to extraordinary levels. Vacancy rates were near zero, and landlords had massive pricing power. Rents were rising so fast that investors were comfortable buying properties at a loss because they expected rents to keep climbing. But the federal government reversed the course. They put a cap on study permits, financial requirements increased, a target to reduce temporary residence from 7% of Canadian population down to 5% by 2027. Canada has over 1 million study permit holders in early 2024. By September 2025, that number had fallen to 725,000. The 2026 target is 408,000. Let that sink in. BC is taking this hit disproportionately. The province recorded a net loss of 48,943 non-permanent residents in 2025, one of the sharpest reversals in the entire country. BC posted a negative population growth in 2025 for the first time since 2012. 19,628 people emigrated out of BC last year, up 32% year over year. The largest outflow in over a decade. More supply, less demand, rents go down. And the Fraser Valley, one of the primary landing zones for international students and workers, felt this faster than almost anywhere else. Let's talk about what this actually means for investors and landlords, because this isn't abstract. This is affecting real cash flow, real mortgage payments, and real decisions right now. A lot of investors who bought condos in the Fraser Valley in 2021, 2022, 2023 did so under certain assumptions. These assumptions were the rents would keep rising. They modeled aggressive rent growth to offset high prices and rising borrowing costs. For a period that worked. Unfortunately, that environment is gone. CMHC flagged that rent increases at turnover across Metro Vancouver were the lowest in 20 years. Many landlords aren't raising rents for existing tenants at all. Not because they don't want to, but they know a vacancy costs more than keeping someone in place. Here's something the headlines don't capture: the concessions. Across the Fraser Valley, landlords are now offering move in bonuses. You heard me right, move in bonuses. 1 to 2 months of rent free just to get units occupied. Those don't show up in an average rental data. So the real effective rent is even lower than what is published. For condo investors, it's a squeeze from both sides. Rents are falling and asset values are also falling. The benchmark condo pricing in the Fraser Valley is now 491,600, down 7.5% from December 2024. Lower rental income, lower property value. Some investors are holding, others are listing. That surge in listing is adding to inventory overhang, keeping resale prices soft. If you own a rental in Surrey or Langley right now, my honest advice is this: value your tenant. A reliable long term tenant paying slightly below market is worth more than chasing an extra $100 and ending up with a vacancy that can cost you in thousands. In this market, the best strategy is tenant retention. Now let's talk about the one factor that makes the Fraser Valley story genuinely different from a market like suburban Ontario or anywhere else: infrastructure, specifically the Surrey-Langley SkyTrain extension. 16 kilometers, 8 stations along the Fraser Highway from King George in Surrey all the way to Langley City Centre. Nearly $6 billion of investment with a completion target of late 2029. Every major SkyTrain expansion in Metro Vancouver history has done the same thing. It has repriced the neighborhoods. Example, Coquitlam after the Evergreen line, condo prices near stations rose 25% in 2 years. Richmond after the Canada line, 10 to 15% above surrounding areas. Right now, Langley is priced like a car dependent suburb. Once SkyTrain opens, it will be priced like a transit connected urban center. That gap, that's the long game for patient investors. But here's the honest caveat: we are 3 to 4 years away from that line opening. The SkyTrain is a long term tailwind. In a market dealing with short term headwind, those are two different time horizons. Be honest with yourself about which one you're operating in. Let me break down the three areas of Surrey Langley corridor where the rental dynamics are most pronounced right now. Zone 1 is Surrey City Centre and Wally. This is ground zero. 12% drop in asking rents year over year, one of the sharpest declines in all over BC. 308 active listings in that corridor alone. If you're trying to sell a condo there, it is sitting on the market from 50 to 70 days. If you own here, you may need to price aggressively to compete and get sold. Zone 2, Newton. A different story, same result. Historically, one of Surrey's most stable rental markets, but renters who used to settle for older stock in Newton are discovering that they can rent a brand new unit in Surrey City Centre for the same price. So Newton's landlords are now competing against shinier, newer products downtown. So the rents in Newton have fallen from 12 to 20% from its peak in 2024. Now let's talk about Zone 3, Willoughby Langley. It has definitely been more resilient than Surrey, but still trending downwards. The average one bedroom is around $1,943, down 3 to 6% year over year. The long term story here is tied directly to the SkyTrain. This is an interesting hold for patient investors. So, where does this go from here? Based on the current supply pipeline and the demographic trends, most analysts believe that the period of adjustment continues through at least till mid 2027. The purpose built rental pipeline already in the ground will keep delivering units through 2026. Non permanent resident populations are expected to keep contracting through at least end of 2027. That's 2 to 3 years of headwind on the demand side. But here's the silver lining. Housing starts in BC fell 5% in 2025. Apartment starts down 8%. Developers are responding to this data and pulling back. The supply wave causing pain right now will eventually slow down. Rents will not fall forever. For existing landlords, focus on tenant retention over rental maximization. Don't chase that extra $100 a month if it risks your unit sitting empty. For prospective investors, run your numbers on today's rental reality, not 2022 numbers. If the deal only works with aggressive rent growth built in, the risk profile has changed significantly. And if you're a tenant right now, you have more negotiating power than you had in years. Don't be afraid to use it. If you found this breakdown useful, hit the subscribe button. I cover the Fraser Valley market every month. Real data, no hype. And if you want to talk about what this means for your property or your investment, drop me a comment or reach out directly. See you in the next video.